Today I will share with you the investment strategy that changed my life. The best thing about it, you will have less work and stress than before and still outperform the majority of other market participants. It can be learned in a few minutes, and after doing your initial investment, no or very little effort is required. Sounds too good to be true. Sounds like these fake financial gurus trying to sell you some BS.
Here in my garage, just bought this new Lamborghini here.
Rest assured, I am not selling any overpriced courses. All advice is for free. I will not participate in any shape or form. The only payment I take is in the form of likes and subscribes. And these are completely free. Hello and welcome to Finance with Axel. Give me a few minutes of your precious time and I will share the best financial, non-financial advice you will find all over YouTube. Keep in mind that I am not a financial advisor. Nevertheless, the strategy presented is based on scientific evidence and long historical data. I will start with describing the strategy in general and the principles it's built upon. Afterwards, I will also show you a way how you can implement these theoretical findings quickly and easily in practice using an example. There are two approaches to investing: active investing and passive investing. Active investing means actively either by yourself or by hiring a third party which acts on your behalf. The goal is to achieve so-called alpha, an excess return compared to the market. This can be done by market timing, getting out at the top and re-entering after a dip at the bottom, as well as by abdomining diversification in order to enter into undervalued assets which should outperform. Passive investing means to try to match the market return, which you will never be able to do completely, but approximately. This is due to the fees payable. I am a huge proponent of the second. In the following, I will show why the active approach not only causes much more work and stress, but also smaller returns. Passive investing, in a nutshell, means to buy a broadly diversified index fund or ETF, then forget about it. This strategy is called buy and hold. Most people don't buy all in one lump sum, but often put a certain amount aside every month to invest. Both strategies work fine. These monthly contributions can be automated so that you only have to set it up once, then you just have to lay back and enjoy life and care about the things which really matter, like your family or hobbies. This approach has a long time horizon. It could be, for example, that you save for retirement. You basically accumulate wealth over many years and don't care about short and midterm ups and downs on the market. In the long run, stock markets move in only one direction, and that is up. Many people also try to find favorable entry points and exit points to generate a better return. The theory behind this is that if you know what you are doing and have a good sense of timing, you can significantly increase your returns. Unfortunately, this idea fails in practice. There is a theory called the efficient market hypothesis, which says in short that all publicly available information is already priced in. This means you cannot outsmart the market and find undervalued stocks or time the market perfectly, since the current prices already reflect all publicly available information. Only insider information enables you to outperform, but using these is illegal and you can end up in prison if you get caught. This theory is highly controversial, especially under practitioners. In the scientific community, this theorem is widely accepted though. Of course, the market is not 100% efficient, but it is very close to it, which means that it is almost impossible to achieve an excess return based on good analysis. I mean, if you are honest and think about it, this makes a lot of sense. There are countless professionals, investors who are trying to outperform. Even they fail in the long run. What gives you the confidence that you can achieve it? Trained pros don't make it, who have supercomputers at their disposal and a lot of time and a big budget for research. Moreover, banks and the financial industry regularly hires the best graduates direct from university. Now you come along, doing something else in your main 9 to 5 job with way less time and know-how. But you still think you can swim with the sharks and don't get hurt? To be honest, even the professional investors do not have an edge. This has been shown by countless studies. Even if you argue that you are hiring a professional who has had exceptionally good results and a very good track record in the past filtering out the bad advisors, you are very mistaken. Past performance is no indicator for future results. This also has been shown by studies. You have probably even fooled yourself because outperformers usually demand particularly high fees on basis of past performance. Unfortunately, the results were almost certainly due to luck and not to investment skills. This means you are getting average returns with extraordinarily high fees.
It's a trap!
So it's presumptuous to think you can beat the market. Even supposed experts do not perform better. You should avoid them as well, especially as they often charge high fees for their services and still underperform.
I got $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
Another proof of the efficient market hypothesis is that monkeys throwing darts randomly assigning a portfolio of stocks didn't do worse than investment professionals who created a portfolio from the same pool of assets. This proves that it is very difficult or even impossible to generate alpha, a return that is higher than that of the market. Instead, you should focus on the variables you can actually influence. Yields are random and hard to predict, meaning we need to optimize other metrics. There are two things in particular that can be influenced. First, your asset allocation, and second, the fees. Asset allocation involves dividing your investments between different assets, such as stocks, bonds, real estate, and cash. The asset allocation decision is a personal one. The allocation that works best for you changes at different times in your life. You have to choose your asset allocation by yourself. It's different for everyone and it changes over time, as mentioned. The older you get, the less risk tolerance you usually will have. You are attempting to balance risk versus reward by adjusting the percentage of each asset in your investment portfolio according to your risk tolerance, goals, and investment time frame. What sounds very complicated actually means, in essence and somewhat simplified terms, that you have to decide how much risk you are willing to take and how high your risk bearing capacity is. You have to decide how much of your portfolio you want to invest risky and which part should be invested risk-free. Risk-free is misleading. It does not mean without risk, but with very low risk. This term is still used a lot in science and from some advisors too. You could, for example, decide that you want to split your portfolio 50-50 between risk-free and risky assets. This would mean that, for example, you hold 50% of your assets in stocks and 50% in cash and cash equivalents like governmental bonds with a short yield to maturity and a good rating, meaning low risk of default. The larger the stock part of your portfolio, the more risk you are willing to take. This increased risk is rewarded with a higher expected return, but at the same time also bigger volatility, meaning that you have wider swings in your net worth. Stock markets go up and down a lot. Cash and short-term bonds stay at approximately the same value over time. As a guideline, you can remember the longer your time horizon, the more risk you should be willing to take. If you are only 20 years old, without a family and are saving for retirement, you could invest your entire assets riskily in the stock market. Based on today's data, this risk will always pay off and you should end up with significantly higher returns than with a more conservative strategy. It would be insane to put all your money into risky investments 1 year before retirement. If you have bad timing, you could end up retiring with way less money than required if stock prices collapse this year. Moving on, the second approach to increasing our returns on investment is to optimize the fees. We should practice a strategy of fee minimization, meaning that we are only investing in index funds and ETFs with the smallest fees. We also do not buy and sell on a regular basis. A lot of back and forth trading is stressful, and there is also scientific evidence that this leads to underperformance. This is because nobody can predict what will happen next, but trading has a lot of fees associated with it. It only costs extra money without increasing the expected value. Fortunately, the fees today are usually quite affordable, at least on the right brokers. The bigger problem are rather the taxes to be paid.
Where's all your money gone, Daddy?
Taxes.
Bug, it's okay. It's part of the game.
No, it's not.
It's
It's not fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
Most tax systems favor long-term holders over speculators, meaning that holding has tax benefits which should not be underestimated. Another big mistake most investors make is the so-called home bias. People tend to invest most of their money in the home country and not diversify worldwide. I will illustrate why this is a big mistake with an example. If you are born in Japan and only invested in the Japanese stock market, you would have done very poorly compared to most other countries the last 30 years. To avoid such a shortfall, you want to invest worldwide, making sure that poor performance of one country can be offset by the good performance of another one. Diversification is the only free lunch, says the quote attributed to Nobel Prize winner Harry Markowitz. What we will do is invest into a worldwide portfolio. The world should be represented as realistically as possible according to the actual economic structures. Fortunately, we do not have to do this ourselves by buying index funds or shares all over the world. Instead, there are providers who can perform this task for us reliably and at low cost. MSCI and Vanguard's FTSE are the providers who offer indices for everything an investor might be interested in. To build the world portfolio, you can use different approaches. You can do this in a very simple way with just a single product, or as complicated as you wish with several assets. Briefly, I will explain rebalancing now. You determine in advance what proportion of your portfolio a certain region, type, or asset should take. For example, emerging markets 20% and industrial countries 80%. Should the values of the two ETFs purchased for this diverge, it will be necessary to bring the values back to the initial level. For example, if the developing countries are now 30% of your portfolio, you would be forced to sell some and buy industrial countries to restore an 80-20 ratio. You can never avoid rebalancing between risky and non-risky parts of the portfolio unless you are 100% risky or risk-free assets. The later one is not recommended though. So if the risky part of your portfolio rises to 70% of your net worth and you actually want to have a 50-50 split, you would have to sell stocks and hold more cash. Since it is our goal to have as little work as possible with our portfolio and we want it to be as straightforward as possible too, I will present you with a solution based on just one product. The one product solution also has the advantage that you have to do less rebalancing and that you can really sit back and do nothing and concentrate on the good things in life. A product to cover the entire world is the MSCI ACWI, the All Country World Index. You can find products matching this description on justetf.com, for example. I usually sort by TER or total expense ratio. The lower the better, as we want to minimize fees. I also want it to be physical replicating and to have an accumulating distribution policy, meaning that dividends get reinvested. The first one is having a little less risk than a synthetic replication ETF. The second is a personal preference. I want the dividends to be reinvested. This can have tax benefits. It also means that I don't have to reinvest them myself, which would cause me additional tasks and therefore work. The filters on the side are also not perfect. Pay attention to not accidentally buy something you don't want, like ESG screened ETFs or other ETFs that only invest in a small portion of the things you actually want to invest in. You can do this by opening the spreadsheet. Inspect every potential product in detail before buying it. The best one I could find is the iShares MSCI ACWI ETF. It has a total expense ratio of only 0.2%, and the index is composed of companies both from developed and emerging market countries worldwide. This ETF is a great low-cost way to get exposure to a portfolio of worldwide diversified stocks. This way of investing has changed my life, as I now have much less work with portfolio management and still better performance, allowing me to beat 80% of the other market participants in terms of yield. It's also a lot less stress because I've gotten out of the habit of constantly looking at prices. And now, in the long run, my investments will pay off. The only thing I still have to do is the rebalancing once or twice a year. the buy and hold strategy presented is optimal for the stock market. It might not be the optimal approach for other markets. The less information efficient the respective market is, the less profitable this strategy becomes. In case of high intransparency, expert knowledge can help to use these inefficiencies to one's personal advantage and to generate excess returns. In the crypto market, there are indications that buy and hold, or as it is called in crypto, HODL, could be the superior strategy too for most investors. However, only when investing in blue chips such as Bitcoin and Ethereum, this is true. In addition, the available market data is still too short and statistically insignificant. Furthermore, the market is still much less mature than the stock market, so it is much more feasible to generate an excess return through active investing when trading in cryptocurrencies. What do you think? Have I convinced you? Will this video change your investment strategy? Let me know in the comments. Thanks for watching. Please share, like, and also subscribe if this was helpful. Bye until next time.